what's the number one fallacy that we were told our whole lives? That you'll be in a lower tax bracket. So what I do is I ask at the beginning of my workshops or my retirement classes, how many of you think that taxes are going to go up in your retirement? And everyone gives me a thumbs up. I've never had someone put a thumbs down. And we blow away that fallacy right off the bat.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional. He is Tim Stearns, CFP, founder at TJ Stearns, Inc., a resource to proactive planning, saving, and investing Chicagoland area residents. If you've got money in the market, if you are making your way toward retirement, even if you're in that transition phase or already retired, Tim and the team there at TJ Stearns Inc. are a resource for you to make sure that you are covering your bases, that you've left no stone unturned, that you know what you need to know to plan efficiently and effectively. Tim, always a pleasure to have you on the program. All of that and still just your average normal guy, right?
Yeah, Peter, I try to keep myself humble. We're here to help people, and it is tax season. And literally, the name of this show should be Navigating Tax Season because, one thing I know about tax season is this. Every time we file, I don't care if you're a CPA, you play the I shoulda, coulda, woulda game, right? So most people are just, mitigating taxes and just trying to fix whatever they did last year, but it is what it is. Why not get ahead of it now for this year? A lot of great opportunities right now for like Roth conversions and doing things like that. So, those are the things that we're really honing in on with our clients because we've got a lot of new ones from this radio show, and most of them come in here with one common theme, and that is I'm sick of paying high taxes. So we show them ways to fix that.
A couple quick questions, Tim. Do taxes disappear in retirement?
No, sir.
Do
They do not.
do the brackets drop for retirees?
No, they do not.
Do most retirees understand the amount that they will be paying in taxes once they get there?
Absolutely not. There's no way.
Are people planning effectively then for taxes into the future?
Not in my opinion. The people that we've been having call from the show are saying to us over and over, how do I fix this? And there's a lot of different ways to mitigate taxes. Our CPA will tell you in most cases, he's a historian. He's going to tell you what you did last year and now what you'll pay for last year. But why not get ahead of it instead of being reactive, being proactive and looking at what your tax bill is going to be? And Peter, we always talk, the example that we give is if I walked up to you on the street and I asked you how much was in your IRAs, your 401ks for your retirement, could you tell me? And the person can tell you within probably $5,000 what that is. But if you ask them over their lifetime how much they think their tax bill is going to be, they look at you like deer in headlights. They have
Yep.
no idea.
Yep. And that's why, ladies and gentlemen, you need to really dig into it. And we'll be covering that in the program, navigating not only tax season, but taxes for life, right, Tim? And Tim Stearns, CFP, along with his team at TJ Stearns, try to help their clients not only to navigate it, but to control it and minimize the tax bill that you have over your lifetime. And that's an important step in proactive planning, ladies and gentlemen. So if you would like to get a start on that, or if you've got any questions about your investments, your outlook, your plan for retirement, or if you'd like to get together that Protect and Grow written retirement blueprint, pick up the phone and give TJ Stearns Inc. and Tim Stearns CFP a call at 800-640-2256. That's 800-640-2256, 800-640-2256, or online, tjstearns.com, tjstearns.com. Or Tim, you've got that additional great resource, the online retirement tax bill calculator, where people can go and crunch their own numbers, or at least take a look at what the numbers are likely to be for that lifetime tax bill. Let's get some knowledge there, ladies and gentlemen. How much are you likely to pay in taxes over your lifetime on those retirement accounts? You can go and crunch the numbers at mvpcfp.com. mvpcfp.com. That's like most valuable player and certified financial planner, mvpcfp.com. SIPCOSJ.com is the website, brought to you by Tim Stearns, CFP. So you can calculate your retirement tax bill. And Tim, I'm sure you get some response from that those numbers are pretty eye-opening as well.
Boy, you took the words right out of my mouth. They are very eye-opening. Many people, the one that I show people in class or workshops is a person with $500,000 who's 65 years old, and we say that their returns are going to be about five and a quarter, which is about what the S&P has done the last 24 years. And then we also show them that they have about 1.25 in fees. And that person who's 65 years old and will live to be 90 pays about $300,000 in the different taxes that they're out there through what they're paying in RMDs, what their reinvestment taxes would be, and lastly, what their beneficiaries would have to pay due to the Secure Act. It's shocking to me how many people, when we're talking in these workshops, don't know about the Secure Act, and they don't know about the Secure Act 2.0. They don't realize that even Roths and IRAs are all going to have to, if you are left to a non-spouse, in most circumstances, the accounts have to be drained to zero within 10 years.
And Tim, that means additional taxable income if it's still a yet to be tax deferred account on those beneficiaries. Like we understand, leaving wealth behind is a fantastic thing. And maybe it is also involving some tax bills or costs or issues there. But this is maybe perhaps like unnecessary additional level of tax or increasing tax on those beneficiaries and giving Uncle Sam more than his fair share or what is our moral obligation.
Well, Peter, who wants to default to what the IRS wants in their taxes? You know that you have a tax bill. We can actually, accentuate that and show you what those numbers look like. And then you can start to, I always talk about, gnawing on the number of the tax bill, and trying to figure out how you can take a little bit off the top, by working within that 12% tax bracket is what I see a lot of people doing when they finally realize that income tax rates are the lowest they've been since the early 80s. And before that, it was the 1920s. So how many more times are we going to have this opportunity? Of course, we've talked about this in the past, but at the end of this year, the tax bill expires unless Congress can get their act together and pass an extension. We're going to revert back to the old numbers. So I think this year really is important to take advantage of these times that you could be paying less taxes.
And again, taxes do not disappear in retirement. They are not written in the tax code that retirees will pay less in taxes. In fact, taxes are slated to go up into the future. Tim, we've got to worry about what taxes might do over the next 25 to 30 years when we're in retirement. And I think a lot of people probably feel like taxes are going to go up over that period of time or at some point in the future. So how do we get started on this? I mean, I know you talk a lot about strategies for controlling this bill. How do we navigate not only tax season now, but moving forward proactively?
Well, Peter, just to back up for a second, what's the number one fallacy that we were told our whole lives? That you'll be in a lower tax bracket. So what I do is I ask at the beginning of my workshops or my retirement classes, how many of you think that taxes are going to go up in your retirement? And everyone gives me a thumbs up. I've never had someone put a thumbs down. And we blow away that fallacy right off the bat that taxes are going to be higher. It's true. It's not even a rumor, So what I do is we will sit down with someone and we run the numbers and show them, number one, what their tax bill is, and then show them that if we start to do some Roth conversions, we can chip away at that huge tax bill that they're going to have if they default to the IRS's system.
And nobody wants to default to the IRS's system. I
No.
mean, is the IRS's plan in anyone's best interest, Tim?
That's an easy answer. No, they are not. That's why we need to make sure that we get ahead of this. Again, being proactive.
So, Tim, steps to prepare for tax filing may be different than steps to prepare for tax planning. But as we are looking at all the documents come in, are there any important steps to prepare for this year specifically to file our taxes?
Well, you want to make sure that you took advantage of any deductions that you can have out there. If you're a do-it-yourselfer, the good news is a lot of those softwares won't let you make errors, and they'll catch you if you are making an error. So that's great. But I mean, if you're using we have a CPA on staff, but if you are using a CPA, you would hope that that person is not going to just default to the IRS's system. It can give you some insights as to how you're going to be able to, uh, push down the amount of taxes that you're going to have, even for last year.
And I mean, documents in the mail, Tim, anywhere we need to check, we need to go through one by one. We need to, my big one these days, and then maybe, you can echo this or agree or disagree. Like, I don't even know, are my tax forms going to come in paper or do I need to go online and retrieve them? And I think that is leading to some additional difficulties in our new modern technology age.
Oh, and I agree with you, and that's why I would tell people make sure that are dotting your I's and crossing your T's and making sure that if you get, one bank might send it electronically, the other bank might do something differently, work, that type of thing. They're supposed to send it out by the end of January. We hoped they already did that by this time of the year, but you never know. And things do get lost in the mail. That's the other thing I would do. And the last thing you want to do is have to refile. It's just a pain.
Yeah. Any other big common filing mistakes that you see, Tim?
Yeah, I see people that didn't take advantage of putting money away in an IRA. And right now, at this time of year, you could be doing it for both last year and this year, or better yet, a Roth if you're eligible to do that. Of course, you have to have earnings. So if you are retired, that's going to be hard to do. But if you are still working, take advantage of that. If you can do a Roth, if you're going to be in retirement 20 to 25 years, why would you not take advantage of that?
Um, So, Tim, as we're talking about tips for filing efficiently, maximizing deductions, all of that, what is your general guidance on the pay me now, pay me later? Should we be looking to pay as little as possible on last year, or should we actually be looking to maybe voluntarily pay more than what we would otherwise have to?
I mean, under these current income tax rates, I would want to pay more right now because in the future they're going to go up. President Trump has said that he'd like to extend it 4 to 5 years. Better yet, he wanted to do it permanently. I don't see anyone signing up for that, but another 4 to 5 years of these low tax rates sounds pretty good to me. And regardless of your party, who wants to pay more income taxes?
Right. Again, we're talking with Tim Stearns, CFP, Certified Financial Planning Professional, your resource, ladies and gentlemen, for not only the common sense approach to planning and covering your basis and understanding the risks, issues, and opportunities that you have into and throughout retirement, but also to get that written Protect and Grow retirement blueprint. And if you would like to get your plan in place, addressing income, investments, taxes, healthcare, legacy, and so many other facets of a sound financial outlook. That's what he offers as part of this program. All you need to do to get the process started, pick up the phone and give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. So Tim, a Roth conversion can be seen as one of the best strategies to create tax-free income in retirement. Those accounts can grow tax-free indefinitely because they don't have required minimum distributions unless they're passed to the next generation and inherited, right? But
That's correct.
talk to us about those advantages. What are the key benefits of doing a Roth conversion? And when should we maybe consider that Roth conversion? During our working years or wait until we're retired?
I mean, there's every case is going to be different, but I mean, in most cases, I would tell you to probably wait till you're retired and you are somewhat used to paying a certain amount. You're going to be living on a lesser amount, so why not look at doing some Roth conversions at that point? We try to again keep people in that 12% tax bracket if we can help it. But I mean, every little bit helps. And if you're not going to pay it, someone in your family is going to. So I think it's advantageous to at least go through the exercise. If you're out there and you're wondering if you should or should not, give us a call and we'll run the numbers for you and it'll show you, and I'd say 90% of the time that it makes sense to do it.
Do we need to really focus on comparing our paycheck during our income earning years with what our projected retirement expenses are when considering Roth conversions and tax management?
It's a great idea to do that, but again, there begs the question: do you have a retirement plan? Meaning, do you have a written income plan where you're saying, "Hey, we're going to take money from these accounts, do some conversions." Most people who come in here, if they have any plan at all, and I'd say about 1 out of 10 has a plan, it doesn't involve when they're going to do their taxes, when they're going to do conversions. They might have an inflation kicker in there, and that's about it.
What do people need to consider when making those calculations and considering their tax brackets and tax cost of Roth contributions or conversions?
Well, I mean, a lot of people don't realize that when you're doing a Roth conversion, the idea is to, pay the taxes with outside money, not the actual money that you're, doing a Roth conversion on. So we always make sure if people want to do that, that they're understanding that we need fresh money to pay the taxes. Otherwise,
You
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 kind of
can
defeat
you
the
can
purpose.
have it withheld from the conversion itself, though, right?
Of course, you can. I think a lot of people that I see that are retiring have some money kind of keeping their, powder dry, as they say. It makes sense to use some of that money that's being lazy in like a savings account, and to do that.
Why is that, Tim?
Why are they
Why
keeping?
is it better to use money that's in the savings account?
Well, because number one, it's really not doing anything. And number two, you want to keep the ball rolling so that most of the money that you did the Roth conversion on is continuing on in a Roth, because you'll never be able to contribute to it again besides doing conversions.
Okay, okay, I get it. So, like, if we convert over $10,000, let's just say,
Yeah.
right? And I've got the ability to withhold it from the conversion itself. So actually only eight lands in the Roth.
Yeah.
I'm not going to be able to make up that $2,000 with additional contributions at a certain point in time. So
It-
rather, it's better to keep it all in the Roth. Also,
yes.
the money that's sitting in cash in the bank, if that money grows more, we owe taxes on it again. Whereas if it stays in the Roth and grows there, it's tax free.
Yeah, it's just shifting money into a better performing vehicle that you'll never pay taxes again. And we even, we don't have time in this show, but the ugly head of Irma will rear its head at some point for many of our listeners out there. So another great way to mitigate Irma is to, it's a Medicare surcharge. If you make too much in retirement, is to have some money in Roth that you're actually able to use so you don't pop up into that tax bracket where they're charging you extra for your Medicare.
So either is possible, probably either is good. Both are good, but
Yeah,
one method is kind of better than the other if we can swing it.
exactly. And I would, hope that people can do that, but if they can, I mean, every little bit helps that you can let it grow again, you
So the
know.
Roth conversions, Tim, I'm sorry to interrupt there, but the
Yeah,
Roth conversions almost opposite of those qualified charitable distributions that you've talked about, right? The Roth conversion, it's maybe better to use the cash that you have to pay the tax bill, whereas the qualified charitable distribution, if you're
yeah.
giving to charity, it's better to use your IRA money. Nuances.
Exactly. Always, and then you're not paying taxes on that and on the qualified charitable contribution one, which is nice, but I would take that from my IRA at all times.
Okay. A lot of nuances with the
Oh
tax
yeah.
code and the tax planning. And I think that's why people miss opportunities, right? We talked about kind of overlooked opportunities. I think people are missing the opportunities for the Roth conversion, even if they are doing it. Maybe they're missing the nuanced difference between paying with cash versus having it withheld, missing the opportunities for the QCDs. Add up all of these things that get overlooked, Tim, and you could be looking at tens or hundreds of thousands of dollars in extra taxation over your lifetime.
Exactly. And again, it could be on your lifetime, but it could also be on your beneficiaries. So I always tell people, right now, with income tax being artificially low, the brackets are artificially low. Take advantage of this. And hopefully they get extended for 4 or 5 more years, and we're off to the races doing Roth conversions so we can pay less taxes in our lifetime.
And we've been talking a lot about conversions. Did mention the word contributions, but just a distinction there, Tim. These are two different things, and a lot of people think that they are limited on or eliminated from even being able to get money into a Roth. Almost anyone can get money into a Roth, but we do need to understand the difference between a contribution and a conversion.
Right. Contribution would be fresh dollars going into a Roth. A conversion would be taking old money, let's say in an IRA, and converting it over into a Roth. I was on a show the other day and they were talking about that, and people were emailing the host saying, hey, you can't do that if you make so much. No, that's not true at all. You can make $1 million a day and still do a Roth conversion. So that's not a problem. It's when you get into the fresh money going into a Roth that there are income limits.
So, are there other penalties or limitations that we should be aware of when converting pre-tax dollars to Roth dollar retirement type accounts?
Peter, again, there are no limitations to that for doing Roth conversions. You can do as much as you can afford, I guess, is the way to look at it. But obviously, you're going to want to stay within certain tax brackets and not get crazy with going into the highest tax bracket. When I talk in our workshops, I say to everyone, I'm not telling everyone to go out there and do a conversion overnight of your entire 401k,
Right.
but it is worth the exercise to look at nibbling on that tax bill.
But I think this is a good idea. So why wouldn't I want to do that, Tim?
It's teach their own. I mean, yes, it's the best idea out there right now. Again, with them being so artificially low, and I'm speaking of income tax brackets, now is the time, to make, hay while you can into Roths.
But if you convert over 500,000 or $1 million, you have
Right,
effectively just voluntarily bumped yourself into the highest tax bracket. And
right.
at a certain point in time, right, is there are other implications such as the Medicare premiums you talked about at the beginning of the program.
Right. It's an exercise that we go through with people. We tell them what the pros and cons are, but usually the pros win hands down because who wants to pay more taxes in their lifetime and who wants to leave money to their spouse that they're going to pay more taxes on? And then lastly, their beneficiaries that are non-spouse that have to drain it within 10 years. No one wants to pay more taxes. So, I mean, let's pay up to our legal limit and then let's try to mitigate.
Strategies to reduce taxes into and throughout retirement, Tim. Starting early is always beneficial, but no better time than now.
Well, yeah, right now you can do that double Roth contribution. You could do the double IRA contribution. One is better for others, the other one's better for others as well, depending on your situation. But this time of year till April 15th, there's some good opportunities to double up on that.
I heard somebody speaking recently, and they were differentiating between tax risk and legislative risk, and it was an interesting difference
Yeah,
to me. Is they said tax risk is the risk that you'll pay more in taxes than you expected in retirement, right? I thought my taxes were going to be lower. Well, they're
yeah,
not. You're paying more. Tax risk, right?
right.
Legislative risk, Tim, is that Congress can change the rules. The tax code is written in pencil, they said, and Congress has an eraser.
It's fair.
And so the rules that we have saved the money under, the pretense of how we have made the contributions and built the money, those rules could be completely different by the time we use the money in retirement.
That's correct. Literally changing the rules in the middle of the game. But for this year, 2025, I know the rules. I know what the tax rates are, and I'm going to take advantage of it for my clients. And that's important.
Well, taxes are complicated, costly. They're a thorn in all of our side. Trying to navigate and simplify and reduce that tax bill, that's a process that should be a common goal, I think, with investor and advisor, right, Tim? And
I
you
agree.
spend a lot of time with not only your clients, but your team of professionals trying to help clients achieve that goal.
That's right. And I think that they give us a call or they go on that website, www.mvpcfp.com. They'll see that it makes sense to definitely mitigate some of those taxes.
That's mvpcfp.com, mvpcfp.com. You can also start the conversation with Tim and the team there at TJ Stearns Inc. by going to tjstearns.com. So a couple great domains. Don't forget them, write them down, tjstearns.com or mvpcfp.com is that online retirement tax bill calculator. And of course, Tim Stearns CFP always makes the offer on the program that if you would like to get your personalized written retirement blueprint, the Protect and Grow plan, all you need to do is pick up the phone and give a call to get that process started. 800-640-2256. That's 800-640-2256. 800-640-2256. Specifically, if you'd like to learn how to control your tax bill, minimize that tax bill into and throughout retirement and beyond, legacy as well. Pick up the phone, get that Protect and Grow written retirement blueprint, get the plan in your hands for 2025 and beyond. 800-640-2256 is the number to call. Tim, always a pleasure having you on the program, talking about what is a very important because it's a very costly topic.
I agree, Peter. And, if you don't do anything about it, you're going to pay a lot more in taxes. So thanks for having me.
Yeah, more money, more problems was the old saying, right, Tim?
And it's like, so true with taxes.
It really is. The more you have, the higher your income or net worth, the costlier an issue this is to ignore.
I agree, Peter.
Always a pleasure, Tim. Thank you.
Thanks, Pete.
Talk to you next time.
See ya. Bye-bye.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.